Welcome to the Deep Dive. We sift through the noise to bring you the insights that matter. Today we're looking at a new property launch, one that's generating quite a bit of buzz. Springleaf Residences. Sources are suggesting it could be one of the most affordable new launches in 2025, especially being right next to an MRT. But is it really the investment bargain, it seems? Or are there potential traps hidden beneath the surface? That's our mission today, unpacking the investment potential for you.
Yeah, what's immediately striking, and pretty rare these days, is that direct access to the Springleaf MRT, a proper sheltered walk, too. So this deep dive, well, it's about clarifying the real pros and cons, helping you figure out if this fits your financial goals.
All right, let's dive right in then. Give us the headline facts, the absolute must-knows about Springleaf Residences.
Okay, so it's a 99-year leasehold, 759 units. And the TOP, temporary occupation permit, that's expected Q3 2028. And like we said, the big one, just a 2-minute sheltered walk to Springleaf MRT. That's the Thomson-East Coast Line.
Right, the TLL. So connecting that to the bigger picture, what does that MRT access really mean for long-term value for someone looking to invest?
Well, it's a huge plus. I mean, that line gives you a straight shot to places like Orchard, Shenton Way, and soon it'll even connect directly to Chongqing Airport. That's massive convenience. And for drivers, there's the north-south corridor coming up. That's the new expressway. It's rolling out between 2027, 2029, roughly. And projections say it could cut maybe 10, 15 minutes off peak drives downtown. Better connectivity usually helps value.
Okay, so location, future connectivity,
Yeah.
checks those boxes. But what makes this particularly compelling for investors? You mentioned affordability. What's the story with the cost?
This is where it gets really interesting. The land cost. The developer got the land for $95 per square foot per plot ratio. PSF, PPR, that's the metric. And the key thing is that was about 8% cheaper than a similar plot sold just a year before.
8% cheaper.
Okay.
Totally. So what does that lower land cost potentially mean for the launch prices, for your entry point as an investor?
Exactly. It really opens up the question of affordability. Analysts are suggesting launch prices could realistically start from maybe $1,140 up to $2,100 per square foot. Now, if that holds true, that puts it below the typical 2025 average for a suburban condo right next to an MRT.
Below average. Can you give us an idea, like for specific unit types?
Sure. So potentially, you might see some one-bedroom units launching under $900,000. And finding a three-bedder under $2.5 million, that's within, say, 200 meters of an MRT, that's exceptionally rare today, really stands out.
Okay, that does sound attractive. So putting it all together, land cost, projected launch prices, what's the potential bottom line? What could the returns look like for you?
Right, let's try a scenario. If we use a standard 5-year exit model, basically, projecting your JAM if you sell after 5 years. A 3-bedroom unit, let's say you bought it at $2,300 PSF. The potential gross gain could be around $322,000.
Wow, okay. And in terms of return on your actual cash investment?
After leveraging a bank loan, which most investors do, that $322,000 gain could translate to roughly a 45% return on your cash outlay, which is, pretty substantial.
Sure.
And the rental yield. Even being conservative, it could probably sit just under 3%.
Sub 3%. How does that compare?
Well, it comfortably beats the typical interest rate on, say, a CPF loan. That's the common government-linked housing loan here. So your rent could potentially cover more than your interest costs.
Okay, that paints a strong picture for potential upside. But like always, there are nuances. Let's talk considerations. What are the potential red flags investors need to be aware of?
Definitely a few points to weigh. First, schools. For families, there are actually no primary schools within that crucial 1-kilometer radius.
Okay, that could matter for resale later.
It could narrow your pool of potential buyers, yes, if top primary schools are a priority for them. Second, about 30% of the units, the stacks, face the expressway. So road noise might be a factor for those specific units, something to check on viewing. And lastly, amenities. While the MRT is there, things like F&B, shops, they'll be limited right nearby until the adjacent plot, Parcel A, is developed.
Parcel A, what's planned there?
That's slated to be a mall, but it's not expected to be ready until late 2028, around the same time as the condo's TOP, or maybe slightly after.
So a bit of a way for those immediate conveniences.
Exactly. You're trading some initial convenience for that future development potential.
So wrapping up our deep dive on Springleaf Residences. On one side, you've got really compelling pricing for an MRT-adjacent property, strong future connectivity.
Yeah.
Look like a solid investment play on paper
Yeah.
for capital growth and maybe rental yield.
Right.
But on the other side, you have to factor in the current lack of nearby schools, potential noise for some units, and the wait for immediate amenities like shops and restaurants.
Absolutely. The critical question for you, as someone considering this, is really about priorities. How much value do you put on that long-term potential, the growth driven by connectivity, versus needing those immediate conveniences and school options right now? This project really highlights that classic real estate balancing act, patience versus potential.
We hope this deep dive has given you a much clearer picture to help with your own decisions. We'd definitely love to hear what you think. Feel free to leave a comment below. And just a quick note before we sign off, this podcast was created using AI technology.